Have you ever noticed how the insurance industry basically acts like a real-time mirror for global anxiety?
Oh, absolutely. It really is.
Right. Like if you want to know what the people in the tallest skyscrapers consider to be the greatest threats to humanity.
And the greatest opportunities for profit.
Yeah, honestly, the profit part too.
Yeah.
You don't look at political polls. You look at where the biggest insurance companies in the world are putting their money.
Because it is a highly quantified map of human risk. We're talking about institutions that employ thousands of mathematicians to literally place multi-billion-dollar bets on what the world will look like in, 5, 10, or 20 years. They don't have the luxury of just guessing.
No, they really don't.
Yeah.
Which brings us to the mission of today's deep dive. We're tracing a very specific money trail today, which is global insurance mergers and acquisitions,
Yeah. Right.
or M&A. We've got our hands on some freshly compiled data from Clyde & Co.'s annual insurance growth update, along with some really brilliant analytical deep dives from beinsuretalks. And I want to be clear right up front about why you, listening to this, should actually care about what sounds like, dry corporate finance data.
Because it's really not dry at all when you look under the hood.
Exactly. This isn't just about spreadsheets and stock prices. Following this M&A money trail reveals the hidden architecture of our future. Like we're talking about how the financial world is quietly preparing for everything from rogue artificial intelligence to the harsh realities of the global energy transition.
That underlying why is what we are after today, because when an insurance behemoth completely shifts its acquisition strategy, it eventually changes the cost of doing business for everyone. It trickles down to how a tech startup gets funded.
Or how a supply chain operates.
Right. And ultimately, how you, the consumer, interact with daily risk.
Yeah, and we really need to set the stage from our current vantage point here in 2026. Because looking back at the data from the past few years is like, I don't know, looking at the vital signs of a patient who just ran a marathon, fell off a cliff, and is now sitting in a very expensive recovery room.
That is a very accurate metaphor. The numbers are wild.
They are. Okay, let's unpack this. Let's look at the sheer volume of money moving around and the dramatic shift in buyer psychology that this data reveals.
Well, to understand where we are in 2026, we have to look at the whiplash of the last 3 years. In 2023, the sector experienced an absolute peak. We saw nearly 350 completed transactions globally.
Wow.
Yeah, it was 346 to be exact. It was one of the strongest periods for insurance M&A on record.
So, to put a visual on that, 2023 was essentially the corporate equivalent of grabbing everything off a Las Vegas buffet. Like, money was cheap, it was moving fast, and companies were just trying to bolt on as much revenue as possible to get bigger.
But then 2024 happened.
The buffet shut down.
The buffet completely shut down. The market didn't just slow down, it slammed into a brick wall. Deal flow crashed to a 16-year low, dropping all the way down to just 204 deals.
That's a massive trough.
Huge. And the mechanics of that crash are really important. It wasn't that companies suddenly decided they didn't want to grow. It was a direct reaction to global instability and, crucially, the rapid rise in interest rates.
Let's break down that mechanism for a second, because I feel like interest rates sound so abstract to a lot of people, but they physically stop deals from happening.
They do.
If a massive private equity firm wants to buy a billion-dollar insurance broker, they aren't paying in cash out of a checking account.
Far from it. No, private equity relies heavily on leverage, which is just, a fancy word for borrowed money. They use debt to finance these massive acquisitions.
Right.
So when central banks around the world aggressively hiked interest rates in 2024 to fight inflation, the cost of that borrowed money just skyrocketed. The financial models that made a, say, $5 billion acquisition look highly profitable on a Monday suddenly showed a massive loss on Tuesday.
The math just literally broke.
Exactly. The math broke.
Which brings us to the data for 2025. So the Clyde & Co. report describes 2025 as a period of stabilization. We saw 211 completed transactions worldwide, so barely a bump up from the crash of 2024.
Right.
But looking just at the number of deals completely misses the plot here, because while the transaction count stabilized, the actual size of the deals absolutely exploded.
This is where the structural shift becomes super visible. During 2025, buyers completed 15 deals valued at $1 billion or more.
Insane.
And even more staggering, 7 of those transactions qualified as mega deals, meaning the price tag exceeded $5 billion each.
And there is this wild detail buried in the sources that I found fascinating. 4 of those massive mega deals were completely anonymized globally. Like,
Hmm.
we don't even know which corporate titans were swallowing each other.
Yeah, the secrecy at that level is intense.
It is. And it fundamentally changes that Vegas buffet analogy.
Hmm.
If 2023 was piling your plate high with whatever you could grab, 2025 was like a wealthy executive walking into a Michelin star restaurant and ordering a single, incredibly expensive, carefully chosen steak.
I like that. The strategy pivoted from growth at all costs to intense portfolio optimization. Insurers looked at their massive global footprints and realized that, well, being everywhere and doing everything was actually a liability.
Mhm.
Yeah, according to the Beinsure analysts, these buyers are now hunting for very specific architectural upgrades. They want immense scale in a single region, massive distribution reach, or cutting-edge technology platforms. They are essentially amputating weak limbs to strengthen the core.
Wow. Which begs the obvious question. If buyers are being this ruthless and they are hunting for these specific $5 billion stakes, where exactly in the world are they finding them? Because when you look at the map of this big money, the traditional centers of gravity are really shifting.
They really are. The undeniable engine of the 2025 recovery was the Asia-Pacific region. The acceleration in APAC was just extraordinary. They jumped from 39 deals the previous year up to 59.
It's a huge jump in volume.
Yes, but the dollar value is the real story here. APAC held the majority. 4 out of the 7 of those massive mega deals we just mentioned.
Right, the numbers are staggering. Like, we are looking at a $10 billion deal in Hong Kong, an $8.5 billion move in Taiwan, and Japan alone dropped over $15 billion across just 2 massive acquisitions.
To understand that Japanese buying spree, you really have to look at their domestic situation. Yvonne Land, she's a partner at Clyde & Co. She noted that Japanese insurers have spent the last few years undergoing rigorous portfolio adjustments at home.
Meaning what exactly?
Mechanically, it means they've been selling off stagnant local assets and cleaning up their balance sheets. So now they are sitting on massive reserves of pure cash.
Oh, I see.
Combine that cash with a shrinking domestic population, and they basically have no choice but to aggressively buy their way into growth markets across Asia.
So they are essentially hoarding supplies at home to fund a massive foreign expedition.
That's a great way to put it. And the sources point out they are looking way beyond the usual hubs like Singapore. Places like India and Thailand are becoming prime targets. And Australia is also benefiting from this broader reorganization.
Okay, wait. I'm looking at the raw data here, and something doesn't totally track for me. We hear this constant narrative about Asia being the future of global finance, right?
Right.
But you look at the pure number of transactions, the Americas are still sitting at the very top. The Americas recorded 77 deals in 2025, and the U.S. alone accounted for 52 of those, with 8 over $1 billion. So is the data lagging behind the trend, or are we missing something fundamental about the American market?
What's fascinating here is that it's actually about the direction the money is flowing. The U.S. isn't just a destination for capital, it is the primary engine exporting it. The sheer scale of the multinational insurers headquartered in the United States means they are the ones driving the international M&A activity.
Ah, okay. So those 52 deals aren't just like companies in Ohio buying companies in Texas.
Exactly the opposite. American carriers and MGAs are increasingly pursuing outbound cross-border expansion. They are using their massive domestic revenue to buy their way into foreign markets. So a high deal count in the U.S. often reflects American money shopping overseas.
Okay, that makes a lot more sense. Now, let's pivot and look at Europe and the Middle East, because the mechanics of the deals there seem entirely different. Europe was incredibly steady, hovering around 57 transactions, but they did claim the crown for the single largest transaction of the year.
Oh, yeah, that massive $10.2 billion deal in Switzerland.
Exactly. But what really stood out to me in the European data was the renewed obsession with the Lloyd's of London platform.
Yeah, the renewed interest in Lloyd's is a massive indicator of where risk is heading globally. Because Lloyd's isn't a traditional insurance company, you know? It's a marketplace where multiple financial backers form syndicates to share the risk of highly complex, unusual policies.
Right.
So the fact that major global players are suddenly fighting to get back into Lloyd's, it signals a desperate need to access specialized, complex risk modeling.
So to everyone listening, keep a pin in that idea of complex risk, because that is going to be the absolute core of our next section.
Yeah.
But first, we have to talk about the Middle East and Africa, the MEA region.
Right.
Because on paper, it looks irrelevant. Just 15 transactions in 2025. That's the lowest volume globally. next to Latin America.
Hmm.
But Peter Hodgins, another Clyde & Co. partner, pointed out the Middle East commands a massive premium. Companies are paying an absolute fortune for those 15 deals. Why is that?
It completely comes down to regulatory moats. You cannot simply rent a skyscraper in Dubai, throw up a sign, and start underwriting multi-billion-dollar infrastructure projects.
I mean, I wouldn't mind trying, but
You'd be shut down by lunch. The regulatory landscape is notoriously complex for outsiders. To operate there, you need deeply established local licenses and talent that actually understands the regional risk landscape.
right.
So insurers are paying massive premiums in the Middle East because buying a pre-existing licensed local player is often the only legal and functional way to enter the market.
You aren't buying the company's revenue, you're buying their passport.
Exactly.
Okay, so we've tracked the volume, we've mapped the geography, right? We've got the Asian cash reserves, the American outbound engine, the Middle Eastern regulatory moats. But that leaves the most important question of this entire deep dive. What exactly are they buying?
This is where the data reveals a profound fracture in the industry. Eva Maria Barbosa from Clyde & Co. described 2025 as a tale of two cities.
The tale of two cities.
Yeah. On one side, you have the traditional carriers, the giant century-old insurance companies whose names are on sports stadiums. Their M&A activity has been cautious, slow, and highly selective. But on the other side of the city, you have the intermediary space.
The brokers and the MGAs.
Yes, that side of the market is experiencing an absolute frenzy of acquisition, largely driven by private equity firms pouring billions into funding their rapid expansion.
I need us to define some jargon here for a second, because intermediary or broker makes them sound like guys making cold calls to sell life insurance.
Right, which isn't the case at all.
No. And the data specifically highlights MGAs, managing general agents. So what is an MGA mechanically, and why are the biggest companies on earth fighting over them?
Mechanically, a managing general agent is fundamentally different from a traditional broker. A broker just connects a buyer with a seller. But an MGA is granted actual underwriting authority by the giant carriers.
Okay.
Think of an MGA as a highly specialized, agile laboratory of mathematicians and tech experts who figure out how to price risks that the giant carriers just don't understand yet.
Okay, let's use an analogy. The traditional insurance carrier is a massive, slow-moving cargo ship. It's incredibly safe, it's incredibly well-funded, but it takes 10 miles to turn around.
Yeah.
Suddenly, the ocean is full of a brand new type of cyber torpedo.
Yeah.
The cargo ship knows it needs to dodge them, but its radar is 50 years old. So instead of trying to rebuild the cargo ship from the inside out, they just go out and buy a fleet of hyper-advanced speedboats equipped with the latest radar to sail out in front of them. The speedboats are the MGAs.
That is an incredibly accurate mechanical breakdown, and it perfectly explains why the middlemen are the hottest commodity right now. It all comes down to the pivot towards specialty lines of risk. The data explicitly highlights that the strategic opportunities driving these billions of dollars are energy transition risks, cyber exposures, and artificial intelligence.
Here's where it gets really interesting, because we have to think about the human actuary sitting at a desk trying to do this math. If you are a traditional insurance company, you have 100 years of data on house fires. You know exactly, down to the decimal point, how likely a kitchen is to catch fire in a given zip code.
Yep.
But how many data points do you have on an autonomous AI agent accidentally causing a cascading copyright infringement event across a Fortune 500 company servers?
You have zero. The historical data just does not exist. Evaluating the compounding liability of AI or underwriting the physical risks of transitioning an entire national grid from coal to untested renewable tech, it requires a completely different kind of mathematical modeling.
It requires tech-native talent that century-old institutions simply do not have.
Yeah.
So they don't try to hire them one by one. They wait for an MGA to spend 3 years building the exact algorithm to price AI liability, and then they drop $3 billion to buy the whole laboratory.
Which is exactly what the data shows us happening in real time. The sources trace this trend back to 2024, when Zurich Insurance Group acquired AIG's travel business. That was a highly targeted move to absolutely dominate one specific niche. Then, the strategy accelerated into what the industry calls strategic bolt-ons.
And a strategic bolt-on is exactly what it sounds like, right? You aren't buying a whole new car. You are buying a hyper-advanced fuel injector to bolt onto your existing engine to make it run faster.
Precisely. It is plugging a new capability into a massive existing distribution network. And this culminated at the start of our current year, 2026, with the first massive mega deal of the year.
Zurich's monumental acquisition of Beazley.
Exactly. Beasley is renowned for its specialty and cyber risk capabilities. So Zurich buying them is the ultimate validation that the future of insurance is entirely about owning these specialized tech-driven niches.
So bring this back to you, the listener. It's easy to view all of this as just an abstract game played by billionaires.
Hmm.
But with private equity inflating these agile intermediaries and giant carriers buying up tech-driven MGAs, it fundamentally alters your reality.
It does.
As these massive integrations happen, the insurance market you rely on for your business, your home, or your startup is changing. The days of broad, one-size-fits-all policies are dying. They're being replaced by hyper-specific, algorithm-driven coverage models. They are buying the math to understand your future risks before you even realize you have them.
That is the ultimate takeaway. The infrastructure of risk is being digitized and specialized. So, looking ahead through the rest of 2026, Peter Hodgins at Clyde & Co. forecasts a cautious but very clear uptick in M&A activity.
Right.
There's a massive amount of pent-up demand and deep pools of private capital, specifically targeting those tech-heavy strategic bolt-ons we just talked about.
But the sources are also very clear that it is not all smooth sailing. There are persistent threats that could trigger another 2024-style freeze. Geopolitical instability is the obvious one, right?
Yeah.
If global supply chains break down or conflict zones expand, confidence just evaporates.
Yeah.
And then we have the lingering ghost of interest rates. If inflation spikes again and central banks make the cost of borrowing money more expensive, the mathematical engines behind these mega deals will stall out immediately.
The environment requires immense discipline. Companies are actively divesting, like literally selling off profitable arms of their business, just to ensure they have the cash to retreat from volatile areas and focus solely on those high-tech, specialized niches we discussed.
Which brings me to a final, lingering thought I want to leave you with. When we stare at this global map of capital, the billions dropping in Japan, the American outbound engine, the desperate scramble for AI algorithms in Europe, there is one massive region that seems entirely forgotten by the major players: Latin America.
Yeah, the sources noted that LATAM had exactly 6 completed deals in 2025.
6.
6. That is the lowest volume globally by a massive margin. On the surface, it looks like a dead zone for M&A capital.
It really does.
Yeah.
But the analysts at Beinsure pointed out some massive structural shifts happening just beneath the surface. You have incredibly large, historically unbanked populations that are suddenly coming online. There is a sweeping, rapid expansion of digital banking infrastructure across the continent. Financial inclusion is just skyrocketing.
And when a population enters the digital financial system, their need for complex financial protections scales up almost instantly.
Exactly. And the Beinsure data specifically calls out the creation of brand new opportunities in segments like warranty and indemnity insurance in Latin America.
We should probably explain what that is because it's crucial.
Yeah, so warranty and indemnity insurance is basically corporate transaction insurance. If I buy your company and it turns out you lied about your tax liabilities or your tech stack, this insurance covers my losses. It is highly complex, it's highly lucrative, and you can only sell it in an economy that has deeply mature, fully digitized financial plumbing.
So the fact that analysts are highlighting warranty and indemnity insurance in Latin America means the fundamental deep-level building blocks of a massive new corporate financial market are locking into place right now.
So as you digest all of this, the panic over AI, the stabilization of the mega deals, the shift from growth to surgical precision, I want you to ponder this. With every major financial giant on Earth fighting so viciously over the traditional Western hubs and overpaying for specialized cyber labs, could the next era of $10 billion mega deals completely bypass the established markets?
It's a fascinating question.
Are we going to wake up in 2030 to find that the greatest financial growth story of the decade was quietly happening in the rapidly digitizing, highly populated markets of Latin America, while everyone else was distracted trying to figure out the math on artificial intelligence?
Time will tell.
So what does this all mean? It means the global architecture of risk isn't just shifting, it's being entirely rebuilt, $1 billion algorithm at a time. Thank you for joining us on this deep dive into the sources, and we'll catch you on the next one.